Let me ask you a question. How safe is your safe money? It seems like a pretty simple question, but the answer? Well, it's surprisingly complex. And I'm not talking about risky stocks or anything like that. I'm talking about the cash you have just sitting in the bank. Today, we're going to pull back the curtain on a hidden risk that could be silently chipping away at your savings.
I mean, there's a certain comfort in seeing that balance in your bank account, isn't there? It feels accessible, it feels protected, and it feels like it's completely under your control. This quote really captures that universal feeling of security we all get from it.
So whenever the news is filled with economic uncertainty or things feel a little shaky, what's our natural instinct? We retreat to the safety of cash. It makes sense. It's tangible, it's stored somewhere we trust, and it feels like a fortress protecting our money from all the chaos out there.
But what if that feeling of safety is just an illusion? What if there's a hidden danger in letting your money just sit there? A force that's silently working against you even when your account balance looks exactly the same.
Well, that hidden force has a name, inflation. And it's kind of like a silent thief. It won't ever show up on your bank statement. You're not going to get an alert on your phone about it. But believe me, day by day, it's quietly stealing the value of your hard-earned savings. So what is inflation really? It's pretty simple. It's the rate at which the cost of everything, from your groceries to your gas, goes up. And as all those prices rise, the purchasing power of your money goes down. Each pound, each dollar you have, buys you a little bit less than it did before. Let's make this real. Imagine 10 years ago, you had 10,000 pounds saved up. You did the smart thing, right? You tucked it away in a safe place, like a cash account, feeling totally confident that it was secure. Okay, now let's fast forward to today. After a decade of inflation has been silently doing its thing, what can that same 10,000 pounds actually buy you now? The result is kind of staggering. In terms of actual purchasing power, that 10,000 pounds is now only worth 8,337 pounds. You've lost over 1,600 pounds of real value without spending a single penny. It's almost like it just vanished into thin air. You see, this isn't just a case of your money not growing. It's about it actively shrinking. You are getting a negative real return of 1.8% every single year. Holding cash wasn't a neutral decision at all. It was actually a losing one.
Okay, so the natural reaction here might be to think, all right, I get it. I'll just be smart. I'll jump into the market when it's going up and get out before it goes down. This is called market timing. And as we're about to see, it's a trap that even the experts can't seem to avoid.
Just take a look at this chart. The gray bars? Those are Wall Street's expert predictions at the start of each year. The blue bars? That's what actually happened. In 2008, they predicted a positive return. The market plunged 37%. In 2013, they predicted a tiny gain, and it skyrocketed by 32%. The point is, the experts are almost always wrong, and a lot of times by a huge margin.
The investment expert Charles Ellis put it perfectly. Over the long term, the market's direction is actually pretty predictable. But in the short term, it's total chaos. And you know, trying to predict chaos is just a recipe for disaster.
And here is where the danger of trying to time the market becomes crystal clear. If you had just stayed invested in the S&P 500 for this whole 20-year period, you would have earned a 7.47% return every year. But if you tried to time the market and you missed just the 30 best days, your return would have been negative. You'd have lost money.
Just let that sink in for a second. Only 10 days out of more than 5,000 trading days. Being out of the market for just the 10 best ones would have sliced your earnings by more than half. The market's biggest gains often come in these short, totally unpredictable bursts, and usually right after a big dip.
So, if trying to time the market is a trap, what's the solution? Well, it's a really simple principle, actually. Focus on the long haul, not on trying to be clever in the short term.
The first step is to completely change how we think about market drops. This chart shows that pullbacks of 5% or more, well, they happen about 3 times a year on average. They aren't a sign that something is wrong. They are a normal, frequent, and expected part of investing.
And when you zoom out and look at the market over, say, 120 years, all those scary short-term drops just become noise. They're little blips in a powerful, long-term, relentlessly upward trend. The overall direction is clear. It's up.
This data right here tells such a powerful story. Over any 1-year period, sure, there's about a 27% chance of losing money. But if you stretch your time frame out to 5 years, that probability plummets to 11%. And over any 15-year period, the likelihood of a negative return drops to zero. Time is absolutely your best friend when you're investing.
And that brings us to the single most important takeaway from all of this. Long-term success isn't about timing the market. It's about time in the market. That's how you actually get to ride that long-term upward trend we've been talking about. So, let's end where we began. I want you to take a look at your own savings and ask yourself this question. Is my money truly safe, or is it just sitting still while its value is slowly eroding? It's a question that's definitely worth considering. Thanks for joining me today.